The silver market is experiencing the most significant supply shock in modern financial history, not from industrial disruption, not from mining failures, not from geopolitical crisis, from something unprecedented. Coordinated retail investors systematically removing physical silver from the market faster than the system can replace it. What started as a Reddit movement has evolved into a global monetary phenomenon that threatens to collapse the entire precious metals derivatives complex. And the mathematics are unforgiving. Let me show you exactly how this silver squeeze is unfolding. Let me walk you through the numbers that prove the current price structure cannot survive physical demand. And let me explain why $50 per ounce represents just the beginning of price discovery that has been suppressed for decades. Because when you understand the inventory levels, when you see the delivery failures, when you recognize the mathematical impossibility of current paper-to-physical ratios, you realize this is not market volatility. This is systematic breakdown of artificial price control that cannot withstand physical metal demand. The silver squeeze is not coming. The silver squeeze is here. Every precious metals manipulation in history followed the same progression. Artificial supply through paper derivatives, price suppression through high-frequency trading, physical inventory depletion, market structure collapse. London Gold Pool collapsed in 1968 when physical demand overwhelmed paper supply. Hunt Brothers triggered silver manipulation exposure in 1980 when physical accumulation broke artificial price controls. The current situation combines both precedents with retail coordination technology that previous squeezes lacked. Wall Street Silver community represents over 220,000 active participants across 95 countries, systematically accumulating physical silver while documenting inventory depletion in real time. This is not speculation. This is coordination. This is not market manipulation. This is market correction. And the numbers prove systemic breakdown is accelerating beyond recovery. COMEX registered silver inventory has collapsed from 150 million ounces to 47 million ounces in 18 months. Registered inventory represents metal available for immediate delivery against futures contracts. The 70% decline occurred during a period when paper trading volumes remained constant at 200 million ounces daily. The mathematics are impossible. Daily paper silver trading exceeds total registered inventory by more than 4 to 1. Annual paper trading volume exceeds global mine production by over 100 to 1. This level of fractional reserve operation has never been sustainable when physical demand increases systematically. Eligible inventory totals 278 million ounces, but remains mostly encumbered by existing claims and cannot be accessed for spot delivery without premium payments that would break current pricing structures. Available silver for immediate delivery against futures contracts now totals less than 20 million ounces. Physical delivery demands are overwhelming available supplies across multiple channels simultaneously. Perth Mint delivery delays have extended from standard 4 weeks to 12 to 16 weeks for standard products. American Silver Eagle production cannot meet demand despite U.S. Mint rationing dealer allocations. Canadian silver maples face similar supply constraints with delivery delays extending globally, but the most revealing indicator is premium structures across physical silver markets. Coin dealers are charging 35 to 45% premiums above spot prices for retail products. Wholesale markets show 8 to 12% premiums for institutional quantities. PSLV trades consistently at 8 to 12% premium to net asset value. These premium levels indicate severe physical market stress that spot price discovery mechanisms cannot reflect accurately due to paper market dominance over price setting. When physical markets diverge systematically from paper prices, the paper mechanism is failing to represent actual supply and demand conditions. The silver to gold ratio provides historical context for current market distortion levels. The ratio currently trades around 78 to 1, meaning 78 ounces of silver equal 1 ounce of gold. Historical average over millennia approximates 15 to 1. Even modern industrial era average approximates 40 to 1. Current ratio levels represent either massive silver undervaluation or massive gold overvaluation. Given industrial demand growth for silver exceeding mine production, while gold primarily serves monetary functions, the ratio suggests systematic silver price suppression rather than fundamental value relationships. Industrial silver consumption totals approximately 950 million ounces annually and continues growing through solar panel production, electric vehicle manufacturing, 5G infrastructure deployment, and medical applications, accelerated by COVID-related demand. Mine production totals approximately 800 million ounces annually and faces declining ore grades, environmental restrictions, and capital investment limitations. The structural deficit of 150 million ounces annually has been covered historically by above-ground silver stocks accumulated over decades when silver served monetary functions before demonetization. These stocks are now depleting rapidly as retail investors remove physical metal from circulation permanently through private accumulation. Government stockpiles have been largely depleted since the Strategic Defense Stockpile sales during the 1990s eliminated most official silver reserves. Central bank holdings remain minimal compared to gold reserves. Industry stockpiles operate on just-in-time inventory principles with minimal buffer stocks for supply disruptions. Wall Street silver movement emerged from GameStop's squeeze success, demonstrating retail coordination effectiveness against institutional short positions. Silver presented larger opportunity due to decades of accumulated manipulation evidence, smaller total market capitalization, and industrial demand creating price inelastic buying that supports squeeze dynamics. Community growth exploded from initial thousands to over 220,000 members within 18 months, while maintaining focus on physical silver accumulation rather than paper trading strategies. Monthly community purchases estimated between 8 to 12 million ounces of physical silver based on delivery tracking and inventory monitoring across major dealers. Global expansion reached 95 countries with coordinated buying campaigns, creating simultaneous demand spikes across international markets. Local coin shops report consistent inventory depletion and extended restocking timelines. Online dealers implement purchase limits and allocation systems to manage overwhelming demand relative to available supplies. The psychological impact multiplies coordination effectiveness through social media documentation of delivery failures, premium increases, and inventory shortages. Each shortage report encourages additional physical accumulation, creating positive feedback loops that accelerate systematic inventory depletion across retail channels. But retail investors represent only one demand vector. Institutional awareness of silver fundamentals is increasing through commodity funds, family offices, and sovereign wealth funds, recognizing industrial demand growth trends and monetary debasement protection characteristics of physical precious metals exposure. Exchange-traded funds face increasing delivery pressure as premium structures make physical accumulation more attractive than fund shares for large investors. PSLV consistently trades at premiums indicating physical demand exceeding available ETF supply mechanisms. SLV faces ongoing questions about allocated versus unallocated silver backing fund shares. The technical structure of modern precious metals markets operates through London Bullion Market Association clearing with COMEX futures, providing price discovery. The system requires continuous rollover of paper positions by investors who never intend physical delivery. When significant portions of open interest stand for delivery, the clearing mechanism faces insolvency. High-frequency trading algorithms maintain price suppression through coordinated selling during low liquidity periods, particularly during Asian trading hours when COMEX volumes decline. These algorithms respond to momentum indicators rather than fundamental supply-demand analysis, creating artificial price volatility that discourages physical accumulation by retail investors. Central bank intervention historically occurred during previous silver rallies through coordinated selling programs designed to cap price advancement. Federal Reserve swap arrangements with European central banks provided silver liquidity during London market stress in 2008 and 2011. Current intervention capacity appears limited by depleted official stocks and political sensitivity around precious metals market participation. The banking sector faces unprecedented challenges from physical silver demand through commercial lending exposure to mining operations, precious metals financing, and derivatives positions accumulated during decades of manipulation operations. Major banks hold concentrated short positions that face unlimited loss potential during systematic price increases. JP Morgan accumulated approximately 900 million ounces of physical silver over the past decade while maintaining short positions in paper markets. This strategy suggests institutional recognition of fundamental supply-demand imbalances while profiting from price suppression through derivatives trading. Bank accumulation validates retail investor thesis while demonstrating manipulation sustainability limits. Deutsche Bank settled silver manipulation lawsuits acknowledging coordination with other banks to fix silver prices during London daily fix periods. Settlement amounts totaled hundreds of millions, but represented small fractions of profits generated through systematic price control over decades. Legal precedent establishes manipulation acknowledgement by major institutions. Regulatory capture by precious metals industry prevents effective oversight of manipulation practices through revolving door employment between CFTC officials and bank trading desks. Position limit rules contain exceptions that allow unlimited hedging positions by commercial participants, effectively exempting banks from concentration limits that apply to speculative traders. Market structure reform requires either regulatory action that seems politically unlikely or physical demand that overwhelms paper supply mechanisms. Retail coordination represents the latter approach through systematic inventory removal that forces price discovery through shortage rather than regulatory enforcement. International markets provide alternative pricing mechanisms as London and COMEX dominance faces challenges from Shanghai precious metals exchange, Dubai Gold and Commodities Exchange, and bilateral trading arrangements that bypass Western derivatives markets. Eastern demand continues growing while Western supplies decline through retail accumulation and industrial consumption. Currency debasement accelerates precious metals demand as inflation concerns drive institutional portfolio allocation toward hard assets. Federal Reserve, balance sheet expansion, European Central Bank quantitative easing, and Bank of Japan yield curve control create monetary conditions that historically favor precious metals performance over extended periods. The timeline for squeeze culmination remains uncertain, but indicators suggest acceleration through multiple converging factors. COMEX inventory depletion continues at rates that project near zero registered silver within 12 to 18 months. Retail demand shows no decline despite premium increases. Industrial consumption growth persists through electrification trends. Price targets become mathematical extrapolations based on inflation-adjusted historical highs, silver-to-gold ratio normalization, and industrial demand growth projections. $50 per ounce represents 1980 high, adjusted for monetary base expansion. $100 represents ratio normalization to historical averages. Higher levels become possible through monetary system instability or supply chain collapse. But price predictions miss the fundamental transformation occurring in precious metals markets. Physical demand is forcing price discovery away from paper derivatives toward actual supply and demand fundamentals. This transition eliminates manipulation mechanisms that have suppressed silver for decades, while industrial demand creates persistent buying pressure. Market structure evolution toward physical clearing rather than paper settlement could establish permanent premium levels for immediate delivery compared to future delivery promises. This bifurcation already exists in retail markets and may extend to institutional trading as delivery failures increase awareness of counterparty risks in bullion banking. The silver squeeze represents broader challenges to financialized commodity markets where derivatives trading has replaced physical settlement as primary price discovery mechanism. When physical demand overwhelms paper supply, markets must adjust to reality rather than financial engineering. This adjustment process proves painful for institutions maintaining artificial price control through fractional reserve operations. Government response options remain limited by political constraints around precious metals markets and economic implications of acknowledging manipulation. Official acknowledgement of silver market problems could destabilize confidence in other commodity markets and currency systems. Intervention to support current price structures requires silver acquisition that government stockpiles cannot provide. International implications include currency stability as precious metals serve alternative store of value during monetary system stress. Eastern nations continue accumulating gold and silver, while Western nations face inventory depletion through retail demand. This geographical redistribution could affect international monetary arrangements during future crisis periods. The mathematical conclusion becomes clear through inventory analysis, demand projections, and historical precedent review. Current silver pricing structure cannot survive systematic physical demand that exceeds available supplies. Paper market mechanisms require physical backing that no longer exists at current price levels. Market forces will resolve this imbalance through price increases sufficient to balance supply and demand, or through market structure collapse that eliminates paper trading. Either outcome produces substantially higher silver prices as physical reality replaces financial engineering in price discovery. The silver squeeze timeline accelerates as awareness spreads and coordination improves. Each month of continued physical accumulation reduces available inventory and increases delivery pressure on remaining participants. The system reaches mathematical limits where current operations become impossible, regardless of intervention attempts. Retail investors understand they are participating in historic market transition that could establish permanent changes in precious metals pricing mechanisms. Community coordination continues expanding globally while industrial demand provides fundamental support for higher price levels regardless of manipulation attempts. This is not investment advice. This is mathematical analysis of supply-demand fundamentals and market structure limitations that indicate systematic change in silver pricing. Physical demand is overwhelming paper supply. Price discovery must adjust to reflect physical reality. The silver squeeze represents this adjustment process in real time. The only question remaining is timing. When does COMEX inventory reach levels where delivery failures become widespread? When do premium structures break completely away from spot pricing? When does industrial demand compete directly with retail accumulation for depleting supplies? Mathematical analysis suggests months rather than years for critical threshold events. Physical market stress indicators continue deteriorating while demand coordination improves. The silver squeeze is not future possibility. The silver squeeze is present reality accelerating toward inevitable conclusion. $50 per ounce represents just the beginning of price discovery in a market where physical demand exceeds physical supply. And decades of manipulation are being systematically unwound through retail coordination and industrial consumption growth. The silver market is breaking. And when it breaks completely, price discovery will shock everyone who believed paper derivatives could substitute indefinitely for physical metal. In a world where industrial civilization depends on silver for technological advancement, while financial systems depend on silver suppression for monetary control, the contradiction cannot continue. Mathematics always wins, and the mathematics favor silver. This analysis is for educational purposes only. Silver investing involves substantial risk, including price volatility, storage costs, insurance requirements, and liquidity considerations. Physical silver may not be suitable for all investors. This content does not constitute investment advice or recommendations.